Many investors today say the only thing that matters is the Federal Reserve, that the Fed literally is the market. So we invited the two best connected Fed watchers we know, Danielle DiMartino Booth and Axel Merk, to come speak at our recent Peak Prosperity seminar and explain why they remain very concerned about how too much stimulus is dangerously deforming asset prices and killing the purchasing power of our currency. Here's what they said.
Right? I mean, when the term modern monetary theory first came up, people kind of laughed and shrugged it off. It's no longer a laughing matter, right? This is
No, it's a
going to be
practical matter. It's
it's
in
it's
place.
it's in place, not as explicitly yet, but it's pretty much in place, and so. Um,
All right, folks, we're in for a real treat here. The Federal Reserve, in many ways these days, seems to be the market in many people's minds, with the ability to toss trillions of dollars in fresh liquidity into the system, literally at will. Many people have come up of the mindset that really nothing else matters in the markets today except what the Federal Reserve is going to do. So what is it likely to do next? What constraints, if any, does it live under? And what limitations, if any, does it have? We have brought together the two best Fed experts that we know of here at Peak Prosperity, Danielle DiMartino Booth and Axel Merk. And instead of this being a panel where I toss questions out to them, we are literally just going to listen into a discussion of these two incredible experts, really just talking their trade with one another. So Danielle and Axel, thank you so much for joining us today.
Great to be here.
Great to be here, and thanks a lot to pass it on. And I think you asked me to play Chris Wallace here and be a panelist at the same time. So I love doing that because I'll then just control what's going on. I think before we dive into this, we of course love the Fed. I like to blame the Fed for just about everything in the world. But before we do that, let's just take a step back as to, does it matter for any of us, right? And I truly believe the Fed is responsible for the wealth gap in the world, for many of the things. I think the Fed is far more important than the election that's coming up. So I just want to throw that out there. And maybe if so that we can each talk maybe for a minute and a half, 2 minutes on each of these little subtopics that we have kind of made for ourselves. Danielle, maybe you want to give it a shot first as what your thoughts on the current Fed, the good, bad, and ugly, and then I'll try to disagree with you. And if you agree with everything I say, I'll disagree with myself on something. Go ahead.
Well, there's a challenge there. I actually think that the inequality divide started in the United States kind of when unions went too far, and also when teachers' unions came up. And Alan Greenspan happened upon the situation. He admits to this day that he was obsessed with the stock market. He required for there to be a stock market briefing on his desk every morning. And we saw that in the aftermath of October the 19th, 1987, that he put out a one-sentence statement that the Federal Reserve, in its capacity as arbiter of shepherd of the US financial system and banking system, that it would basically be backstopped. He didn't use that word, but my point is, in the weeks and months that followed, something extraordinary happened inside the bowels of Liberty Street and the New York Fed. And that is that Alan Greenspan sanctioned the New York Fed markets desk, basically the trading desk of the Federal Reserve, to give bond traders on Wall Street advance notice of Fed moves to inject liquidity into the system. And I tell that first story because it's become the last story. Investors today have become emboldened, they've become trained, it's become ingrained that they're able to, in Wall Street parlance, front run the Fed, whether it was the tequila crisis, Orange County bankruptcy, long-term capital management, the housing bubble, or the dot-com bubble, and then the housing bubble that was built in its wake of the great financial crisis and the unconventional monetary policy that was rolled out in its wake. Every single iteration has been the Fed training investors to a greater and deeper degree. Don't fight me, don't fight the Fed. And that has manifested in an inequality divide, to Axel's point of, if you go back to 1927 and you look at the inequality divide, the Gini coefficient, 1927 was passed a few years ago and it's just kept going. And the fact that QE became contagious and spread across other central banks has only made the problem globally that much worse. This is not a recession brought on by the coronavirus. This is a situation of over-indebtedness and over-leveraged exposed by the coronavirus.
Yeah, Danielle, I think you make an excellent point, and the way I would phrase it is that the reason why this matters is that if you believe in a free market, you need efficient capital allocation. And if capital allocation is based on a Fed put, that allocates capital very differently. And of course, we feel good when the markets go up and we happen to own equities and so forth, but something ain't right. And I mean, the rise in populism in recent years is just one of the many symptoms of it. And obviously, if you ask anybody at the Fed, they shrug that off and say, no, it's just, and you can deal with that with macroprudential tools, as Draghi would say, right? But if you step in there and don't allow the market to do its thing, you have a problem. And so, yeah, going back to 1927, I mean, you can go back even further on some of these things, but of course, it's, as you've pointed out, this has gone further and further and further, and now we're just so hooked on this. You want to just kind of jump almost 100 years forward and give a comment on where we are right now?
100 years forward from where we are now.
No, from 1927, right? Almost 100 years. That means to 2020, 2019. That's
well. I mean, I think that where we are today is in a situation where the Fed has pushed its own policy so far that it can only get bigger, and the magnitude can only get bigger. The problem is, and I think that this crisis, more than anything else in the past, has exposed the fact that the transmission mechanism between monetary policy and the second mandate of maximizing employment is completely broken. I shouldn't even say broken. The plumbing is non-existent. If Congress doesn't pass stimulus legislation that the Federal Reserve then in turn recycles back into the stock market in the form of quantitative easing, the Fed has no game. The Fed has nothing that it can do. But again, the stimulus legislation that in turn goes directly to people who need the money the most, because there hasn't been any job reskill training. We haven't done what the Germans did starting in 2005. We didn't reskill the workforce. We don't, like Germany, have the lowest youth unemployment rate in the developed world. We've shunned vocational training. We've done no infrastructure spending to speak of. So because so much of the stimulus legislation that has been financed by the Fed and monetized effectively by the Fed has been non-productive for several decades, we're now at a point where the only thing that Congress can do is pass legislation to give people bailouts. And what the Fed does when they buy that in the secondary market is it regurgitates its way through the stock market in the form of higher stock prices for a handful of tech stocks. But as far as productive aims go, not so much.
You mentioned the word transmission mechanism. So we're prone to lingo in this world, of course. But the point of the goal of the Fed is that what they do has an impact of sorts. And obviously the Fed has very blunt tools. They have its bazooka. And so what they have been doing is by printing all this money, they have compressed risk premium. And anybody who's been around since 2008 kind of know what that means, but it takes perceived risk out of the market, not actual risk, but perceived risk out of the market. And they do it in the public markets. Now, unlike in 2008, where there was a huge backlash to the banks, they said, oh, now we're the good guys. And so we have a Main Street facility, as if that were to provide money to quote unquote Main Street, which of course it doesn't. And so if you look at, we are investment managers, and we deal in various markets, currency markets, equity markets, fixed income, and so forth. And so what you see in anything that's publicly traded, the junk space in particular, the yields relative to treasuries is low. And so if you look at some financial condition indices, they have improved. But then if you ask somebody, like who owns a restaurant, can you get a loan? Well, of course you cannot get a loan. I mean, you might get access to the PPP program, right? And the Fed just cannot fix that. They can do certain things, like they can use the bazooka to kind of foam the street, and they say, yeah, everybody is going to be doing so much better if this all is just carried along. And then, of course, I mean, maybe to pivot here a little bit, we have this new Fed interpretation as of a few weeks ago. I'd be curious, Danielle, in your thought on that. I can give you my take, and and what I heard from Fed officials the other day as well, but I'll have you go and give it a first shot here.
So to me, this is smoke and mirrors. Bernanke imposed the 2% inflation target. I'm sure it was probably Greenspan's ideal inflation target was 0%. And that's kind of sort of what, if you're trying to maximize the buying power of the US currency, then it should indeed be 0%. You shouldn't have a target that says in 50 years time, I think that the dollar in your pocket should be worthless. It makes absolutely no sense. But it was Greenspan and Yellen's baby, and boy, did they push it through, and they were so excited about it in January of 2012, and they've hit the target 11 months since then. 11 months since January 2012. And they want to introduce to the world a whole new regime, a whole new framework. I mean, the media went wild that they were going to let it run hotter than 2%. And I kept on saying 11 months. We're not even at 12 months, sporadically spread throughout the last 8 years. And they're trying, I mean, this is, I've never seen a narrative be pushed down as forcefully as this has been. To me, this is a guise behind which they have license to continue QE for approximately ever. But they know they're not by design going to hit it. After 2023, their own projections put it core PC at 1.7%. And we know that rental inflation's come down from 3.4% in February to a 2.7% rate as of this morning, September data. So that's not happening. And yet they have this target out there. And it's further along in our discussion, but when they want inflation the least, they're going to quit complaining about not having it, because at some point the market might give them exactly what they're asking for. But the design by which they're trying to cast this, the narrative, the fact that they've gone out and bought up a ton of the tips market so that they can feed the real yields narrative, bless their hearts, doesn't hold water.
Yeah. Well, let me just make a brief comment and then maybe pivot a little bit. You, I think, very kind to the Fed. You say design. I think this new policy is lacking any sort of design. I attended a Hoover conference, monetary conference meeting, where they have these discussion groups, and this discussion group was just the core Hoover audience. They are quite critical of some of the things that are happening at the Fed, and they were pointing out, hey, yeah, you're taking away part of the policy, like to make it now they're not going to stop printing money anymore when unemployment goes low, but they didn't really replace it with much else. And then another one of these meetings I attended, John Williams was attending, and he glorified all this. Oh, we're just putting guardrails in place, it's all going to be perfect. Now, my own take on this is that very different from the financial crisis, the sort of support that the market is getting is far closer to the consumer. And I'm talking about the fiscal side. When, for example, the tax cut we had under Trump, that's indirectly inflationary. But when you give people cash, yes, or a infrastructure spending program, or many of the programs under consideration, who knows what's going to be passed, that's far more inflationary. And so now what you got is, you got a Fed to be committed to keep rates low no matter what. Mm-hmm. Now, you have different views on how this recovery is going to take place, but odds are some underlying healing will take place, and your time horizon may vary. But at some point, things are going to pick up. And of course, as you keep a lid on rates, real interest rates, meaning rates net of inflation, are going to go down. And especially if they have a commitment to do this beyond the 2%. And so what I see is, I just see we may have a big mess in our hand, because they don't know what they're wishing for. And so if they're going to be sitting on their hands, well, good luck, right? And so then John Williams was asked, well, that does guardrails, and of course we can always change their mind. Well, the chief says he's not even thinking about inflation, and so who knows, right? I mean, the thing is, we don't exactly know what they are going to do, except we know we're printing a boatload of money, and I think no matter who we're going to elect, then we're going to be spending a great deal of money. And with that, maybe do you want to have your thoughts on fiscal policy going forward and how that's going to interact with Fed policy?
Well, so productive stimulus spending wouldn't bother me near as much as what we're seeing. I mean, the Corps of Engineers, it's been 2 decades now that they've identified all of the repairs that need to take place nationwide. So, and that would actually put people to work, and that would be productive in nature. My greatest concern is that the Fed ends up becoming basically an ally, a counterpart to fiscal policy, and is effectively directly monetizing whatever is printed, that it's not going into productive means, and that the rest of the world starts to get concerned about inflation percolating. And I think that what we've started to see in the yield curve, and I don't think it's going to hold, actually. I think that nominal yields are going to come down again. We're seeing white collar layoffs increase. And the fact that we will probably have a negative print for GDP in the fourth quarter, absent stimulus spending prior to the election, means that there will be a real decline in income, and that will have it will create economic weakness in the medium term. But let's just say after the election that the Fed comes in guns blazing and monetizes everything. Again, they don't. Jay Powell himself mentioned that he said we had 7 years with zero interest rates and it didn't create a bubble at all. I mean, I'm going to have to start wearing seatbelts when he's giving press conferences because I fell off my chair. So because we clearly have a bubble. Deutsche Bank did a great, very long-looking report a few weeks back that said that if you look at bond yields and if you look at where stocks are, we're more overvalued than we've been since the 1800s. If you look at the two asset classes in the aggregate. So in the few places where you can see price discovery, commercial mortgage rates, currencies, in the few places where the Fed has not been able to get their tentacles into market pricing, you've got some serious volatility, and the market is telling you exactly where prices should be. But my vision of what I think is going to occur, and nobody's crystal ball ever works, period. But I think we stay disinflationary for a time. And then I think we go towards stagflation and possibly just pure out inflation after that, depending on how long the rest of the world gives the United States to continue running up these massive levels of debt. But I don't think year 2021 being the 40-year anniversary of bond rates peaking out, I don't think the 40th year anniversary is going to follow another 40 years of central banks being able to print whatever they want.
Yeah, I mean, you mentioned the deficit spending. I think one of the big dangers of the environment we're in right now is that politicians are getting a taste that it's okay. You can spend trillions. It doesn't matter what, right? I had an interview the other day, and somebody called me a political atheist, and I had to look it up what it meant. But after looking it up, I considered it a compliment. It means you think for yourself. But I mean, we always elect the other guy or gal. But they all spend money. They just spend it a little bit differently. And obviously, even Hamilton already had trouble bailing out states. So I'm not so sure whether that's one of the more prudent choices to do. But ultimately, I think no matter who we're going to have in office, we're going to be spending a boatload of money. And Powell pretty much has egged them on. I mean, he gave a speech just recently and said, "Yeah, please spend more money, And of course, it's one thing to call for that. It's another one to, at the same time, have all this quantitative easing and monetizing the debt pretty much, right? I mean, when the term modern monetary theory first came up, people kind of laughed and shrugged it off. It's no longer a laughing matter, right?
It's a practical matter. It's in place.
It's in place, not as explicitly yet, but it's pretty much in place, and so.
I mean, giving people $2,400 extra a month and not seeing any inflationary consequence, that's about as close as you're going to get.
Well, the thing is, life always continues, right? People always think that, oh, there's an election, everything is going to change. No, there's always another stage, right? Just as I mentioned this already 15 years ago, at some point, the elderly don't have any savings. And so people said, oh my God, what are all the old people going to do? It's going to be all the catastrophes. No, society is going to change. And everybody who's 65, 70 years old is going to be proud to be working, right? We adjust to it. And so, I mean, ultimately, the question is, of course, what's going to happen in the medium term? And then to kind of take this closer to home, what can we as investors do about it, right? I mean, it's nice to complain about the Fed, but what does it mean for anyone's portfolio? And I don't know, Danielle, whether you ever go down this road, but if you don't go down the road for others, what do you do for yourself, maybe?
You know, look, my public holdings are pretty public, and that is that I've seeded a few companies that I feel like will survive what's to come. I still enjoy the comfort of my municipal bonds and my gold. And right now I'm public enemy number one in the Bitcoin community, because I'm just not quite there yet with a reserve currency changing hands in a non-violent fashion, because all I can look back to is the Roman Empire. So I can't go back any further. But if you go back in time that far, then every time reserve currency status has changed hand, there's been a hot war involved. So for now, I'm happy in my gold and municipal bond and seeding startups bunker.
Yeah. So I can't give investment advice. I'm regulating everything I do, and a lot of people who know me know that we do both gold and gold mining. One of the things that in that space is people like that because that space is so notoriously volatile. You get a lot of diversification with little to do. I mean, and obviously, to me, the important thing in this environment is that everybody has a process. And what I mean with that is, if you just watch the news, you should be excused to be utterly confused in a day or two. And so you got to have your own mind of how this is going to play out and what you want to do with it. And I once wrote a book on how to keep your money, and the summary is you should spend less than you're making. And it may sound very simple, but that's ultimately what it comes down to, because that's one of the few things you can control, right? And so as far as the risks are concerned, you pretty much do what you can afford to take. Or of course you take the other approach. Hey, the Fed has my back, and I gear myself up. I mean, it was
not after working on the inside for 9 years.
Yeah, but that's what people are induced to do, of course, with these record low interest rates, and that can have a hazardous impact. Because if you look, we didn't talk about it, but in March, these markets really had a meltdown in the crash that we had there. We active in some currency markets, and some of these currencies moved more than 10% in a minute or so. That doesn't happen, right?
And the long bond stopped trading in Asian trading one night. It just stopped trading.
Yeah,
the long bond.
Yeah,
it's supposed to be the risk-free. So stranger things can happen, and they can happen very quickly.
Exactly. So if you deal in leverage or derivatives, you better know what you're doing. It's easier to build your own well, as Chris would say, and be able to be self-reliant. Anyway, Adam, did we cover about what you want to cover, or do you want us to have some closing words on a particular subtopic?
You did an excellent job, guys. Thank you. And I do have a couple quick closing questions for you guys, if you don't mind. The first one is, Axel, I think in your words, it was predicting a boatload of money is going to get spent still going forward. And Danielle, you sort of mapped out your thoughts on a road to more inflation going on. We might go through stagflation before we get there, but it seems like you think more inflation is coming in the longer term. So does that boatload of money, more inflation, does that mean higher prices for sure? Because I think a lot of people have been, whether the logic has been sound or not, they've been right in saying, hey, I think what the Fed is doing is inflationary. It's going to drive prices up. And certainly that's what we've seen over the past 10 years. So I guess my question is do you expect to see kind of more of what we've already seen, maybe even on steroids with future trillions of bailouts, or is there enough risk that market-wise, something that is deflationary to market prices could happen and catch people by surprise?
Let me take this first, maybe. First of all, I think we first have a bit of an deflationary shock and then go on the other side too much. But the one thing to keep in mind about inflation isn't just a lever that moves up very, very gradually. Inflation pops up in different places, and then oh, don't worry, and suddenly everything around you is more expensive. And ultimately, to me at least, the most important driver to inflation is inflation expectations. And that might sound a bit stupid, but what it means is if you think everybody around you is raising prices, you're going to do the same thing. And that's why it is so important to have confidence in the system. And that's when you play with fire as a policymaker, it is so dangerous. And so that's why you should err on the side of being conservative and not worry about what happened the last 10 years when you try to do policy for tomorrow, but think about the risks that are out in front of you. But sure, yes, prices have been going up in many things. If you look at some inflation indices that look at online prices, by all means, or just look at your own Amazon shopping cart when you reorder something. Guess what? It's more expensive than last time you ordered it. Danielle?
That's absolutely correct. And if you look at one of the places where the Fed has tried to generate inflation, which is residential real estate, we've got nationwide home prices increasing at 15% right now. We have Fannie and Freddie doing automated appraisal waivers for purchases. So you've actually got more than one government entity helping to feed this narrative of, look at the housing market, it's leading the economy into recovery. Not so much. It's also being engineered. And we have to pay attention to the fact that healthcare inflation continues to rise. And as a mother with a 16-year-old and a 14-year-old at boarding school, I'm telling you, every time I'm in Amazon, I am marching back out of Amazon because I'm reordering something from another website because the prices, it's inflation right now. What people need to understand about inflation, since it hasn't really been around for 40 years in a big way, is that inflation, along with the employment of the US workforce, is becoming automated. And you're being followed, and they know what you want and when you want it, and they're going to price it accordingly. And that's why you have to spend your time, if you're going to shop online, and make sure you go and find the lowest price, because it's not at Amazon.
So it sounds like a monetary version of The Social Dilemma, if you've seen that documentary on
I've seen that documentary, and it's the same thing.
Yeah, God, that's terrifying. Okay, so real quick questions here. If given the choice, A, would you abolish an institution like the Fed? And if not, give me two names of somebody you'd like to see potentially in charge of it. Let's start with you, Danielle.
Oh, gosh, in charge of the Fed, Sheila Bair.
Okay.
I would take Sheila all day long, and on Sundays, I'd bring Tom Hainig back with her.
Okay.
He's not
Axel.
that old. Bring him back.
Okay.
She just got me speechless. I'm not a fan of Sheila Bair, so I think that's a separate discussion.
Hey, that's the benefit of different minds on the program.
And I have to punt here a little bit, because I keep getting invited to some of these conferences. There are very few people from the industry in there, and I do ask some pretty provocative questions there. But if I tell them that they all need to go home, then they're not going to invite me anymore. And so
I'm not worried about that.
Yeah, no, obviously. But the thing is, there are some folks at the Fed. We talked about Charlie Plosser, who's no longer at the Fed right now, or we work with Bill Poole, the former St. Louis Fed president, that have often been the voice of reason. But ultimately, if you're in charge, right, and the world is on fire, everybody who's always been at the helm has taken the fire hose, right? And so Volcker, he had some more prudent views, and he's everybody's quote unquote hero. But the only thing I like to say is it is so much easier to criticize than actually be there. In my view, the one thing I can say, rather than a person, and I've said that since the beginning of the financial crisis, the best short-term policy is a good long-term policy. So anybody who has that view, I would support, in any office for that matter. The problem is, I haven't seen that in government in much of the world in the last decade plus.
Yes, I would sadly agree. And again, not just in government, but I think even our corporate leaders too are woefully too short-sighted. All right, with that, we'll wrap this up. Thank you so much. My last question for both of you as you go, just if people are interested in learning more about you and your work, where should they go? Danielle?
Please come to quillintelligence.com. We've got samples of our research up there. We've got retail and institutional products out there, and there's no bias at all. And then follow me on Twitter at DiMartinoBooth, please.
Great. And Axel?
So the starting point, yep, my most up-to-date comments are on Twitter at Axel Merk, and otherwise merkinvestments.com is our portal to everything and anything, from research reports to investment advice to some financial products and so forth. But follow me on Twitter. That's a great starting point if you want to have my provocative at times comments.
All right. Well, thank you too for this really amazing opportunity just to watch two Fed great intelligent minds share their expertise with each other. It really was a joy for me, and I'm sure it is for the folks watching as well. We'd love to have you guys back on at some point after the elections, after the next boatload of money gets spent and whatever stimulus packages get approved. We'd love to hear your thoughts about what that's going to mean for the future. But until then, thanks so much for joining us, guys.
Thank you.
Great.
And as we do every week, we are going to spend the rest of this video talking with the lead partners of New Harbor Financial, the endorsed financial advisors by Peak Prosperity. I'm joined here this week, as usual, by lead partners John Lodra and Mike Preston. Hey guys, how are you? Happy holidays.
Hey, Adam, happy holidays to you. Thanks for having us again.
Hey, Adam, it's good to be back.
Great to see you guys. Hope you guys have had great times with your family. We're recording this right before New Year's. I wish you guys a happy New Year's Eve. But first off, let's jump right on top of what Axel and Danielle just laid out for us. Again, that was from the Peak Prosperity Seminar. So you guys actually saw that presentation first about 2 months ago or so when they presented it, but it's just as relevant today as it was then. Sadly, because much of what they were mentioning was, a huge warning about the corner that the Fed has trapped itself in, the market deformations that it's caused, and the, as long as they continue their current trajectory, it's going to mean probably lots and lots of bad repercussions and ripple effects for the rest of us. So they talked about an awful lot of stuff. And first off, I'm always amazed when I hear people who have direct relationships with the people involved, right? Danielle used to work for Richard Fisher at the Dallas Fed. Axel, one of his longtime advisors is Bill Poole, who is a former president of the St. Louis Fed. Axel also is in contact through Stanford and other organizations with folks that have sat or continue to sit on Federal Reserve. And so when you get to, it's not speculation when you hear from people like that. They know the actual people involved in the decision making. And to hear them be so unabashedly critical the way that they are, it's one thing for us to be making those criticisms from the cheap seats, but when someone who's that close to the people who are running the show feel the same way, it really, A, it gives a lot of validation to the conclusions we've come up with, but B, it's also more scary because they actually really know what and whom they're talking about. All right, so anyways, long story short, they both were huge criticals of the way that the Fed is distorting the capital markets and capital allocation, which is resulting in tremendous amounts of malinvestment and also in hugely distorted market prices, creating kind of like Axel used the term, the Fed is depressing risk premia, which, in his words, is basically making risk look a lot safer than it actually is. And so the markets have become sort of one huge roach motel where it's really appealing to enter because you're getting this promise of ever higher asset prices. And if you look at the stock markets, it's pretty much what the past decade has given you. The problem is, just like a roach motel, it's easy to enter. It can be very hard to leave. If we end up having another true market correction event, somewhat similar to like we had back in 2008 or in the dot-com bubble burst, a lot of that current market value can disappear in an instant, much faster than the participants' ability to exit the building. So anyways, you look at what Axel and Danielle are talking about, they both seem pretty confident in saying that the Fed's not going to stop printing, the stimulus train is not going to stop, and that means largely, more inflation. Danielle criticized the Fed for pursuing even a 2% annual inflation mark because that means in roughly 50 years, you've destroyed the value of the currency, right? Mm-hmm. And that's official policy. And of course, the Fed has said it's actually happy to let things run hotter than that from here. So, we've talked with some past guests on this program, Jim Rogers, Grant Williams, Steen Jacobson, all who see greater inflation coming ahead. And we've begun talking in some of these recent videos about, all right, how does an investor prepare for inflation? I know that you guys, think similarly to Steen and some of the folks that we've had on predicting a boom coming in commodities and real things. And I know that you've made some recent changes to your portfolio. Can you share with the audience here what you guys have done? Mike, why don't I let you take that football, and John, I'll then get to you about some of the charts you sent over.
Yeah, we've noticed for a few years now, and we're not the only ones, that commodities are very depressed relative to financial assets, certainly relative to the S&P. We've been long believers in gold and silver. Certainly those are a commodity, but they're also a very unique commodity and, happen to have been used as money for thousands of years and is, a true anti-central bank or a non-core, an asset that's outside of central bank control, which is why we like that. But we also like a lot of other commodities too, metals, even some agricultural commodities, et cetera, all have been depressed relative to, the conventional stock market for quite some time. We're talking about depressed over a 10 to 15 year period, the cyclical lows. So we've had our eyes on sectors that make sense to buy or that might provide opportunities in what is otherwise a hyper overvalued stock market. The S&P is certainly hyper overvalued. We like gold and silver mining stocks for the reasons that we like gold and silver, and also those stocks are still very, very attractive valuations. But we also started looking pretty closely at energy, particularly oil and gas, a few months ago. After the correction in March, those names rebounded very well, like the rest of the market did. But energy is only about 2.3, maybe 2.4% of the S&P, right near an all-time low. It's been much higher than that in the past. It's completely out of favor. A lot of these things are trading, 2/3 below their value a couple of years ago. So we've been watching very closely the entire sector. We saw a breakout a couple months ago. We very patiently have been waiting for a pullback, and we finally saw that pullback in the last week or so. And we added a very modest position in oil and gas through an ETF that owns some of the major oil and gas players and refiners. And so the problem with buying anything in this market is almost everything is going to be highly correlated to the S&P. We expect the S&P to show some weakness, frankly, at any moment, although one can't tell when that's going to happen. So we have that position hedged with what's called an option collar. Essentially, what we can say is that we bought a position in XLE in this particular case, and we sold a call above the present price, and we bought a put below the present price. So we have our risk very defined, but it's our way of just kind of nudging and tiptoeing into the sector. So that puts us slightly north of our usual net 0% stock exposure, but we're still under 10% exposed and only in very undervalued assets like oil and gas.
All right, that was a great answer, Mike. And I'm going to put up a chart here that we've shown before, but it shows how we're at sort of historic discounts of commodity prices to the financial markets. Specifically, this chart is showing commodity prices versus the S&P 500. And so there's sort of a couple things Mike referred to. One is that these stocks of commodity players are looking very attractive on a relative basis to the general markets. And so that does give them some comfort that they can, they're buying them at very low prices right now. That said, because they're worried about all assets being somewhat overinflated, they have put in that protective collar. So they're buying insurance against a market downturn. One of the challenges about this time, which Mike's alluded to, is with all things being inflated by the central banks and what's been going on, if you are truly in an asset bubble, as many of us believe, it's really hard to just position your entire portfolio for inflation, because if there is a period of deflation that happens along the way, it can totally kill you. In other words, if you're positioned for inflation and deflation happens, it can literally wipe you out. So, we're all forced to play this speculative game of, is it going to be just inflation run away from here, or do we need to have some of our portfolio positioned for deflation? And John, you had sent over some interesting charts, which I think speak to this, because some people say, hey, don't worry about inflation. If you think inflation is going to happen, just buy the stock market, because stock markets, stocks of all shapes and sizes do well in a general inflationary trend. And I think you've got some charts here that say, hey, not so fast. It's not quite that cut and dry. Can you speak to those charts you sent over?
Yeah, absolutely. And the basic gist here, Adam, is that there's a lot of nuance to what assets do well in different phases of an inflationary cycle. And, one that, to your point, that the mantra is usually, hey, don't worry about inflation. Stocks are usually a good inflation hedge. There's a whole lot more nuance and detail to that statement that needs to be unpacked. So, for example, when you're in a period like we are now, where stock valuations are at their historical extremes, which we can say categorically they've never been this extreme in terms of their valuations as a multiple of underlying fundamentals, revenues, and earnings and things like that. Historically speaking, when stocks are at these valuation extremes, one of the very worst things for those stocks are a sudden move higher in inflation, because what that usually historically has done is caused a massive repricing to the downside of stocks. And I'm going to refer to a chart here that I share with you, and I got to give very, very due credit to John Hussman, one of our very favorite data-driven analysts. And he put together this chart that shows, for the period of the late 60s through the early 80s, which was a period where the stock market kind of did not much of anything, but inflation took root and ended with a very spectacular inflationary mecca at the end of the 70s, early 80s, where inflation was running double digits. Money market accounts where interest rates had shot up to 15% on money market accounts. But if you look at this chart, it shows three things. It shows the CPI inflation, the blue line, okay, and that's measured on the left-hand vertical scale. So you can see in the early late 60s and early 70s there was a shoot higher in inflation, and also you'll see a red line here which shows the S&P 500 cumulative return. So if you look at the left half of this chart, you can see when inflation spiked up, meaning the blue line spiked up, you can see the red line spiked down, meaning stocks sold off. And that happens to be a period of time where stocks were very overvalued, kind of like they are right now in terms of the valuation metrics. But then you see to the right side of the scale when inflation really spiked higher in the late 70s, early 80s. That's where the stock market actually provided a good inflation hedge, but it was because stocks were beaten down to good valuation levels or normal or at least reasonable valuation levels at that point. So really gotta unpack that statement that stocks are a good inflation hedge with actual data and historical perspective. So right here and now, we think one of the very worst places to be is broadly in stocks in the event of an inflation spike, because those stocks will likely sell off in a hurry. And ironically, cash and things like that, liquid cash, safe cash, is likely to be one of the very best places to be, because it then allows you to buy into those stocks at much more reasonable valuation levels.
Thanks. Yeah, and that really gets to what I think is sort of the nefarious undercurrent of what Axel and Danielle were speaking to, which is the markets are so deformed, they're so distorted that the risks of that kind of snapback correction, correction from these all-time extreme highs, that kind of grows every week that asset prices march higher. The problem is that everybody who's trying to basically live off their savings or are watching these markets, they feel like they're missing out if they stay in conservative investments like cash, right? They're getting really no return on it. Any money that's getting deployed into the markets is getting well treated, along this sugar high ride. And so, people we call it getting forced out onto the risk curve, right? They're getting forced out into riskier and riskier investments to try to participate in that return. And of course, what that does is it makes it more and more vulnerable to that snapback, right? So it gets harder and harder to sit on your hands and sit in cash, because on a relative basis, it looks like you're losing out pretty badly. But to your point, John, what really matters is when those cycles turn, right? And if you are fully invested, that's when you can really lose you're fully invested in the things that are at historical valuation extremes. That's when you can really lose your shirts when this whole thing corrects. Right?
Adam, I actually probably overlooked one of the most important takeaways of that chart that we just had up there. If you look over that cumulative period there, Treasury bills, cash in other words, actually outperformed the stock market over that broad expanse of time. So this idea that cash is trash just doesn't jive with history. I mean, there are times where cash is the best place to be.
Yep, and it's interesting because we're in this world right now where cash is trash is kind of the mantra. There's the whole war on cash, where everybody thinks we're going to be moving to digital currencies and maybe alternative currencies like Bitcoin and all that. And by the way, Bitcoin's at a record all-time high today while we're talking here. It's been on an absolute tear for the past 2 weeks. I think trading up at around $28,000 right now. For perspective, I think when we were talking with the Bitcoin expert that we invited on the program, 2 months ago or so, I think it was like less than half that price. So anyways, right now it just sort of seems like, cash is for losers. But I think what you just showed there, John, is a really good reminder from history that unless it's truly different this time, it is not nearly the worthless asset that it's being painted as right now. And of course, the goal is not just to sit in cash the rest of your life. The goal is to do what you guys have been desperately trying to do, which is wait for saner valuations to deploy that cash into the asset classes that you think are going to have the best long-term fundamentals, like a lot of these sort of commodity-based companies that we're talking about. All right, guys. So with that, wrapping up here, we are at the year's end here. We're just 48 hours from New Year's Eve. And as people are watching this, they're highly likely going to be watching it around New Year's or a day or two after that. Beginning of a new year, what are some of the things that people should be thinking of, in terms of investment decisions that they might want to be making early in the year to set themselves up for success in 2021? Mike, why don't we start with you?
Yeah, I think I'd start with the most obvious one. That's the thing that we tell or say to everybody that we first meet. Every new person. It's a great time to review your allocations. If you have ridden the market and done very well in 2020, congratulations. It's been an unbelievable ride. We started the year at with historic overvaluation. We were having a blow off top into February of 20. Because of the kind of the repo madness in the Federal Reserve starting QE4. And then, of course, we had a bit of a bother, a 17-day drop in March, but it's been nothing but a straight up move since then. And so if you stayed in this market, I'd say, now is a great time to review allocations, reduce risk, particularly in stocks significantly. We keep recommending to get down to below a third, maybe 30% stocks. So that's the first thing that we would do if you haven't already done it. We just feel like we have to pound the table on that one all the time. Other than that, a couple tips. And most of them have to do with IRA or retirement accounts. Required minimum distributions are back in 2021, so you can take them early or start to plan for them over the course of the year. Anyone that now turned 72 at the end of the year would be required to take required minimum distributions. Also, you have until April 15th to contribute to an IRA for 2020. So there's plenty of time to do that. And also certain retirement plans can get set up until tax filing date. Not all of them, like generally 401ks and simple IRAs can't be done, but you can certainly do Roth, traditional, and SEP IRAs. A SEP IRA is a retirement small business IRA. You can set those up until tax filing time plus extension. So there's a couple tips that come to the top of my mind.
Great. So folks, if you haven't taken steps on those, highly recommend that you use the time you have now between now and April 15th tax day to take advantage of some of those, either tax savings or, just rebalancing that type of work that Mike was talking about. John, anything else you'd add to what Mike said?
Yeah, I just add, we've been doing a lot of scenario planning with our clients, not just, broadly about financial planning and kind of looking at, I think this last year has been a eye opener for a lot of folks, whether it's because of the pandemic and the reminder of maybe the brevity of life and, delicacy of life. A lot of people are thinking about their long range plans a little differently about, do I want to keep working? Do I have to keep working? Some financial planning, stuff like that, but also around income. And this gets into the IRA distributions and things like that. We have a likely new administration coming in here. Obviously, I think there's still, some, left field, proposals that are, still not willing to concede that the election is done and final. But, it's very, very likely that, in our opinion, that we will see higher tax rates, maybe some reversals of some of the tax cuts that were done in this current administration. So we think it's a good time to think about proactively thinking about elective distributions from IRAs and retirement accounts before you're required to, because quite frankly, we might find that tax rates in 2021 are going to be lower than they might be down the road. So we've been doing a lot of planning like that with folks, and it's very individual, customized kind of conversation in light of each client's own situation and timelines. But a lot of our clients are choosing, this makes sense. I think I should take some distributions now, pay these taxes that we know are at a pretty favorable rate, and know that down the road I won't have to pay those taxes at what will likely be a higher rate. So that's always a timely thing to do, especially with a likely change of tax policy with a new administration.
That's a great reminder, John. And also, too, you kind of putting your finger on something I think that's important to mention here about kind of the crazy year we just had with COVID, which is you guys have just given a bunch of reasons for folks to take action early in the year, no matter what their personal situation is. But, if you're watching this video program, it's probably because you are suspicious of the standard broker that just says, just put your money in stocks, be 100% allocated all the time, and don't worry, the stock market's going to take care of you. It always has. The Fed has your back, right? You're probably a little bit, suspicious, skeptical of that, and worried that if you continue to follow that type of strategy, that you could get burned with one of these market reversals that we've been talking about here. And then you compare that to COVID, where, it's been a reminder of our own mortality, right? And, we've seen some pretty high profile people who have passed away from COVID this year. They weren't planning on it. And a surprising number of them, you read about in the media, didn't have a will. Didn't have an estate plan in place. And so their families have had to scramble about, all right, how do we think they wanted their assets dispersed? And then of course they're having to deal with the tax implications of an estate plan that wasn't, put together to help minimize all of that. And so again, if you're watching this and you're wired this sort of way that I intimated that you probably are, it might be true that the people in your family who depend on you and whatnot, they might not think the same way. It's very common amongst peak prosperity readers as they'll come to us and say, wow, I really appreciate how you guys see the world. I see it similarly too, but nobody else in my family does. And I kind of feel like I'm doing the heavy lifting for them by educating myself. But of course, that only works as long as you're still around. So if God forbid, 2021 comes up and you unexpectedly get felled by COVID or a speeding bus or a meteorite or whatever, a very important question is who is going to be the steward of your money in the way that you would want it to be for the people who depend on you? And so where I'm probably taking too much time getting to the point here, but what I'm trying to say is this is a really good time to try to partner with your financial advisor, maybe even bring in a couple of your family members and say, hey, look, even if you guys don't want to get as close to the data and the numbers as I am, if something happens to me, my advisor knows what I know, and I feel confident that they can, chart the ship after I'm gone. So a reminder to consider doing that too with your current financial advisors. All right, John and Mike, I'm going to keep things, close things up here because we're at the end of our hour. But guys, it's been a wonderful year doing this program with you. We started it, right around the coronavirus crunch in early March, and it's been a hugely successful series. We've gotten lots of great feedback on it, lots of people watching it, but it's a joy to do with you guys week after week. So thank you guys for joining me. And as we wrap up here, a couple real quick things. One, if you want to see this series continue, please take a second. If you haven't already, subscribe to this YouTube channel, click that little bell. That way it'll alert you every time we post a new one of these videos to our YouTube channel. Secondly, if you want to know who we're going to have as future guests and maybe be able to give your own input into who you'd like to see, as always, just follow me at Menlo Bear on Twitter. That's my Twitter handle, at Menlo Bear. And then lastly, you probably know this already, but if you don't, we have created this relationship with the team at New Harbor. Between them and Peak Prosperity, it's lasted now for over a decade. And the reason we do that is because they see the world very similarly to us, and people who have followed Peak Prosperity have long come to us and said, I'd like to at least talk with a financial advisor who thinks like you guys do, so that I can craft a plan for myself. So between us and John and Mike and their team at New Harbor, we've crafted this program where you can reach out to them and get a free financial portfolio review from them, absolutely free. No obligation to work with them, no strings attached. If you have not already done it, it's the end of the year. We're starting a brand new year. Start that new year off right by reaching out to those guys and having that free consultation. And if you've had one, but it's been a while, you can still call them up again and have that free conversation and get an update on to what your portfolio, should be considering as we head into this new year. So if you're interested in setting up that meeting, just stick around to the end of the video here. We tell you how to do that. It only takes you a couple of seconds. And with that, John and Mike, I wish you guys a happy new year and look forward to seeing you guys the first week of the new year doing our next one of these.
Thanks, Adam. Just want to get one quick last word to just say thank you for producing and putting these videos together every week. We talk to people every single day that say they enjoy them, both clients and potential clients. So thank you. We enjoy them too. And we wish you a happy new year.
And may we all have a slightly less exciting 2021.
Well said, John. All right, guys. Well, look, happy new year. Take care.
Happy new year.
Okay. Bye, Adam. If
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.